Howdy, this is David Groce, your Texas tax and lawman. Welcome back to our real estate series, Big Hat, Big Cattle. Today we're talking about taxes on rental properties. In our prior videos, we discussed how to evaluate a good investment, how to get financing, and how to buy your rental property. Let's review the tax aspects of owning a rental property and paying taxes on that property. To begin, there are usually two types of taxes you pay on a real property: state property taxes and federal income taxes. If you live in a state with state income tax, you'll pay that too, but those rules usually follow the federal return, so we're not diving into that. Property taxes. I know it's a shocking statement, but governments want money. They have bureaucracies full of employees, from the street sweeper to the governor, who need to get paid to administer their state. I'm not trying to diminish the need for efficient government and a civil society, but I am decrying the inefficiency of government and its never-ending cry for more. Let's be clear, I live in Texas and we have no state income tax. Texas raises the bulk of its revenues for schools, cities, counties, and the state through real property taxes. The state raises taxes not by raising rates, but by increasing the tax value of your property every year. That means you pay more taxes on the same piece of property year over year, whether you charge more rent or not. Here's the good news. State property taxes on rental properties are deductible. I know the media has told us that the Trump tax cuts have limited the state and local tax deduction to $10,000. That is true, but only on your personal residence. If you own and operate rental property, you can deduct all of your property tax you pay on your rental. The next is income taxes. I know it's obvious, but rental income received by you from your tenant is income subject to tax. The good news is that you get to take ordinary and necessary business deductions against the income. Most property owners report their rental income and expenses on Schedule E, which gives us a list of the usual expenses property owners deduct on lines 5 to line 20. You can see everything from advertising to utilities is listed alphabetically. I, of course, like line 10 that lets you deduct legal and professional expenses incurred in hiring professionals like me to help you. While this list is generally self-explanatory, let me highlight a couple of big concepts for you. Line 12, mortgage interest. When you pay interest to the bank to purchase the property, you get to deduct the interest you pay against the rental income you receive. Line 16, taxes. As discussed above, you get to deduct all of your property taxes against your rental income. Line 18, depreciation. Deducting taxes and interest are usually clear concepts everyone understands, because you write a check to the bank or the state and you actually pay those monies to someone. But depreciation is a totally different thing. Depreciation is a tax concept. Depreciation is the idea that your building is deteriorating and breaking down over time and conceptually losing value. Picture the Greek or Roman ruins. At one time, they were spectacular. Now, a few columns remain in a field of rubble. That will happen to our properties too if we don't take care of them. Scientists call this deterioration entropy, the tendency of things to break down over time. Theologians call this the curse of sin, where everything fades from the perfection of creation. The job of an accountant is to quantify, measure, and track the economic value of things, and they call this breakdown depreciation. The property loses value over time. As a result, the federal tax law has recognized this reality and allows us a deduction on our taxes for depreciation. We do not get to deduct the value of the land, but we do get to deduct the depreciation, the loss in value on our buildings over time. For a residential building, we get a depreciable life of 27.5 years. For a commercial building, the useful life is 39 years. For simplicity's sake, let's assume you buy a duplex for $325,000. the underlying property is worth $50,000. That means you get to depreciate your $275,000 building over 27.5 years, giving you an annual deduction of $10,000 per year. I know tax laws are complex and can be confusing. If you need help preparing the taxes for your rentals, give us a call, and our team of tax professionals can make it easy and get you all the right deductions. Hey, thanks for tuning in. Until next time, adios. Texas Tax and Lawman Legal Disclaimer. Hey, I'm a lawyer. You know I have to have some lawyer mumbo jumbo. This is a general information video, not client attorney privilege information. The content is information only and is not directed to any specific facts or circumstances and cannot be relied upon as a legal opinion, even though that would be nice and save you a trip to the lawyer. If you have a specific legal question, feel free to contact David Groce directly or seek qualified legal or tax counsel in your state of residence, state of mind, or whatever place you call home.